Hey, Paul here, and it's the middle of August, August 15th today. Today is following a day in the markets when they had their biggest drop in, I don't know when. They always have some, whatever it is, 3 years, 2 years, whatever. Certainly this year, 800-point drop on the Dow. All the major indices were down almost 3%. Well, I'll tell you what, I hope you're laughing at the markets. I, we are. Losses are never nice, but when you know that they can be controlled, um, you don't worry about it. You just kind of laugh and giggle and know that this is part of what happens in the markets, and you got to deal with it. Losses are something we want to spend some time talking about today. I took a trip over the weekend. I'll tell you more about that when we get into it with my good friend Don. But thinking about losses and whether they matter or not, apparently there's some different opinions on that. Surprisingly to me, that people would think that losses don't matter, but we're going to explore whether that's true or not, and we're going to get into it right after this. Don, I had an interesting weekend. I had an opportunity to drive out to Ohio to visit a commercial nursery. A fella out there, he's got a YouTube channel, and been watching him for about a year. I've showed you, some of those videos. Interesting operation, and I just wanted to take a look at it. We've got some land here, and we're thinking, down the road, would that be a good way to supplement retirement income and so forth. But it was about a 7-hour drive, and we had guests Friday night, and so I didn't leave till about 11 o'clock at night, and drove out Pennsylvania Turnpike almost all the way to Ohio till I couldn't stay awake anymore, and I pulled over in a rest stop and slept in my car, which was an adventure. They don't really. It's not a big car, I didn't have a sleeper bunk in the back or anything like that, but I got comfortable enough to get a couple hours sleep, and then about 6 o'clock in the morning get up and finish the trip and spend the day at this fellow's nursery. It was really well worth it. That's a long way of me getting to say the radio cut in and out on me. So I actually ended up listening to some podcasts from my phone, and I like to listen to business podcasts and investing and marketing podcasts and things like that. And I heard some interesting things, and I heard somebody mention a particular site which I thought would be of interest to me, and it's an investment management firm that helps people with their 401ks. And so I visited the site, and I got to tell you, I was driving back through PA, and I can still remember where I was when I heard this. I was in this big, flat, long stretch, and I could see the mountains and I just, I looked at this site, and what I saw, it just ticked me off.
Oh.
And I thought, I gotta talk to you about this. It just, I took I'm not going to say the name of the site, but I want to get your reaction to what I'm going to show you. Okay.
All right.
You ready?
I'm good. Fire away.
Right. So, here's what I'm looking at. This was a screen capture of a one page off of that particular site, and it's says market truths. And now I want to play a little game with you, and I'm gonna just throw up a little slide here.
Fact or fiction?
I want you to tell me now, is this fact or fiction? Okay, it says truth, but this is with regard to losing money when the market goes down. All right, this particular site is advising its clients, its investors, that when the market goes down, and it will, which is true, you aren't really impacted unless you sell what you have. you only lose money if you sell. Is that fact or fiction? Is that really a market truth?
It's going to be hard for me not to say a bad word, Paul. But
Well, you go ahead. I'll bleep it out.
That is, in fact, our whole premise is built on the exact opposite of that. So saying that is just verbiage to fill in he's got a nice picture over there about the pig and the money and saving money and what have you, but
Yeah.
nothing further from the truth as far as I'm concerned.
No, I don't think so. It says, you aren't really impacted unless you sell what you own. It says it's just paper losses. That's all that it is. Now, correct me, but if that's true, then wouldn't the same be true of gains? That you're not really making money unless you sell when the market goes up.
Totally
because
true.
it's just paper gains.
Yeah.
Isn't that the same? Wouldn't you have to extend the same thing and say, so how do you measure performance? Oh, it doesn't matter. I bought these stocks, I'm buying and holding them, and it doesn't matter what happens to them. So, well, then, this firm goes on to talk about how they pick the mutual funds that they recommend, and how they don't charge exorbitant fees, and they all this stuff in order to help you get your gains. But it's just paper gains. Why would you even worry about fees and losses and expensive funds if all it is paper loss? Am I missing something?
No, because the truth is, money is very personal to all of us, and we all have different objectives, and we all have the money that's there when you need it. And nobody knows that time, because we all have things that we must use our assets for.
Uh-huh.
And as you alluded to, at the bottom of a bad market or something, if you needed money there, it's just going down further and further. So it's not a matter of right or wrong. It's at the bottom of one of those pictures that you got there, there's less money in your account. I can assure you of that. And so if we need money there, it's not just depends on the day that I was born or the day that I retire. It's either there or not there. And that's the bigger fallacy of making a little blanket statement like that and call it a market truth.
Oh, I know. I just take a look here. I'm gonna look at that horizontal line. I'll try to get the vertical line out of there. What we're looking at is the S&P 500 from about 2000 over to 2013, and along in there, that line about covers for the highs. There's three of them. There's one there, and one over here. Well, if you were an investor and you started right there, and you put $50,000 in your account, then you lost half of it in the tech bubble burst. You made it back, but it took you 5 years to get it back. But then you gave it back in the financial crisis,
right.
And then it took you another 6 years to get it back. I mean, we're looking at, if you started in 2000 and didn't put any more money in that account, it took you 13 years, you made nothing. And most of that time you were underwater. Now those are real losses. And if you wanted to retire right here, you'd have no more than what you put in. And if you wanted to retire right here, well, you'd have a big issue. And so these things hurt. And to say that these losses don't matter as long as you hold what you bought back up in here, that infuriates me. That's a flat out lie. This is more than fact or fiction. And I'm telling you that if this investment advisor, if he is knowingly saying that it doesn't matter when you lose as long as you hold on to what you bought up here, if he's knowingly saying that and knows it's not true, he's a liar. If he doesn't know it and he's saying it and he thinks it's true, he's a terrible investment. He doesn't understand the basics of investing.
Okay, Paul, I'm having it now. It's coming to me. I want you to picture me going down to my banker.
Yeah.
Okay. I'm going to tell him that I've only got $50,000 in my account, but I really had 100 about 2 years ago.
All right. So you had 100 up here, and now you got 50.
I borrow $100,000, but I only got $50,000 now. So you give me some idea of what the banker's going to say. And I mean, I know this banker.
He's going to tell you you're nuts.
Work out. So.
You're saying you're gonna say you had 100,000 up here, and now you got 50, and you walk in around here, and you go, I'd like to take a loan against and use my stock portfolio as collateral, and the banker says, well, how much do you want to borrow? And you say, well, I want to borrow 100,000. He says, well, what's your portfolio worth? Well, it's worth 50,000 right now, but you don't understand. I'm holding on to what I bought up here when it was worth 100,000, and so this doesn't. So I want to borrow 100,000 because it doesn't really count that this is a loss. And that's not a real loss. And how do I know that? Because my investment advisor told me that you only lose money if you sell, and you aren't really impacted unless you sell what you have. It's just a paper loss. It's not a real loss. I think if I were your banker, I'd probably tell you to go pound sand.
That'd be a short conversation at most banks, I can tell you.
Yeah, I told you. If you had to retire right here, if it would be terrible. I will say this: with a 401k plan, and that's what these folks primarily manage, is the advantage of that is you're putting money in periodically. Up, down, doesn't matter. You're putting money in. And that dollar cost averaging approach helps an awful lot, because when the market goes down, you're buying shares that are less expensive. Of course, when it goes up, you're buying shares that are more expensive too, but you're averaging out the cost. And for the most part, it helps you have a lower overall cost because you're buying more of those shares when they're cheaper by putting in the same amount of money every period. That's a great way to invest. It is. But to say that it doesn't matter is just I almost drove off the road, and I just started thinking about, I can't believe that somebody is saying this. I mean, it just doesn't even make sense. And it's not the first time that I've heard it. It's not the first time that I've read it. It's I've seen other places do it too, and it's usually when we're in the middle of one of these big losses or a big drawdown or a market crash or something like that. And it's the only thing you can say to keep people from panicking. It's just say, hey, don't panic. It's not really a loss yet. Hang on. The market always comes back. Yeah, well, if you had started 2000, in 2013, you were just breaking even again. It was more than a lost decade. It was a lost 13 years. A lost baker's dozen of years of going up and down and getting back to where you were. Don't tell me that these losses don't matter. I'll tell you what. I know that you have a PowerPoint. Next time we're together, so I want to go through that and talk about volatility and
cost of volatility.
Cost of volatility. Next time we're going to get together.
And it's some junior high math that nobody in Wall Street ever considers, but it's the cornerstone of the very topic it
is. And I think that PowerPoint you put together brilliantly illustrates the math of losses. So anyway, in terms of this, we're going to pronounce it fiction. Fiction
to the fourth power.
Yeah.
With those little fours up on top of it.
That's right. If someone tells you that losses aren't losses unless you sell them, well, if someone tells you that these things always come back up, I can point to several stocks that have never come back up. I've owned some of them myself. Because because I would, I bought into that. It's
Can't believe you didn't have a wreck. If I was driving and heard that, I'd have probably had to get off to the side of the road or run over somebody.
I remember a phrase one time. I thought it was funny. It was I heard it in a movie called Shogun, I think it was. I'm dating myself because that was back in the 70s or 60s maybe. But I remember somebody said, don't pee down my back and tell me it's raining. And, and when someone says, this doesn't matter, that's exactly what comes to mind, is somebody telling me something and trying to convince me of what I already know is not true. Anyway. Hey, we're at a period right now of some volatility. Today it's the 15th of August, and we're talking the day after the major indices all lost about 3% in one day. Biggest drop on a Dow, 800 points, something like that, and I can't remember how many years. Are you worried? Does it bother you for your portfolio? Now, of course, it's not a loss unless you sell it, right here.
Yeah. As somebody who assisted in the development of our models, it actually plays in our hands to have volatility for this reason. Our portfolio yesterday was down just 1.2 or so percent, right, versus the averages. Most all of them are down in the 3% range.
Right.
So we have a little shallower hole to dig out of than they do, and that's the math. That's the math we're going to talk about next time.
Right.
That nobody alludes to, but it is critical to surviving until you can get back to making money again.
Now, every day you and I get a report on our portfolio and how we're doing. Here's a picture of it there, and let me just say this: that if anybody here would like to get a copy of that, email to them once a week, we'd be happy to do that. Just go to our site and sign up for our weekly updates. And sometimes we put commentary in there, sometimes we don't, but we give you a report on how the models are doing relative to the market. And that doesn't cost you a thing. If you want to do what we're doing, you can subscribe. It's not expensive. It's a flat fee, and we can help you invest in a way that's going to let you sleep at night. Just go to the website and hit subscribe, and we'll get you started. I can't think of anything else. Well, I knew what you were going to say. I knew when I asked you fact or fiction, but I just wanted to set it up. It really caught me by surprise, and it does tick me off to see professionals out there, doing this. And I think I don't know. I just don't think that should happen. I think they should be embarrassed. But anyway,
he didn't do too well in math for him to take that under consideration, because you got a big hole to dig out of. Takes twice as long usually. Is like 08, it was down in a year 50%, and you take 3 or 4 years to dig out of there, because you can't go back and gain 50%. Plus you have to gain 100% to get back in. So
that's right.
I'm glad he's doing it, and more power to him.
Well, I'm sure that he's helping some folks. He makes some good points on his site that, a lot of 401k investors are just sitting in their money market fund, earning next to nothing. Yeah. And, if he can help them do that, but I just think it's just a misleading. It's more than misleading. It is a fiction, and it's a flat out lie to say that losses don't matter. So what do? Well, you diversify, right? He helps do that. He picks he tries to build a diversified portfolio. And you and I know that there's some benefit to that, but you and I also know that you can over diversify, and that drags you down. So well, all right, wait. My grandson was down in your neighborhood and shot a hog down there. I had dinner with him last night. He was down in Albany. You know where Albany, Georgia is?
Sure.
Yeah, that's where Yeah, that's Central Georgia.
Yeah.
And then he said he broke down in his car about 45 minutes north of that on the way home. So
that was a pretty good jump to go from Pennsylvania all the way down there to shoot a hog.
Yeah, well, and it cost him a bit of money to do it. And they came. It was two of them. He and his friend. They came home with one hog. It's getting processed up here, but for what they spent, the two of them. to each end up with about 60 pounds of pork. He could have bought 3 pigs up here. They each
some more foolish things than that. So I just don't want to tell all the ones that I did.
Well, they had fun. They sure had fun, and they'd have some stories too. Turns out I said, who actually shot that pig? And he said, well, we both did. He says, I shot it and I hit it inside, and I thought I knocked it over, but then he says, it got back up, started running. He says, so Jesse shot it and knocked it down. And then, and we think he killed it. But then later on, there was another pig came into view, and the guide said, all right, guys, go ahead and shoot. So Jesse shot the dead pig again.
There's always a story now. There's always a story for a trip like that.
Oh, anyway. All right, my friend. Good to talk to you.
Good night.
Yeah, I'm going to do that. And, folks, if you want to, follow us on this channel here, hit follow, and then hit the little alarm button, so that the bell there, so that you get notified whenever we do a new video. Visit us at stonebarnportfolios.com. Sign up for our weekly updates, or subscribe if you want to invest the way we invest. Good to be with you today. Nice to be with you, my friend. You take care.
Yes, sir.